Well, good afternoon, everyone, and thanks for joining our monthly webinar. Today we're going to be going over the ins and outs of enterprise value or business value. It's a top of mind topic for many business owners, and I think it's fair to say that a lot of business owners perhaps don't understand it. We do get a lot of questions about it, and in particular, I guess two recurring questions. So, what is my business worth? And how do I go about actually driving that business value up? So today we're going to delve in detail into the areas of enterprise value. We're covering off the reasons for understanding business value, how business valuations actually work. So the process for going about valuing my business, in particularly SME valuations. We'll be looking at the differentiation between enterprise value and equity value. It's a concept not often understood. And finally, we'll be wrapping up by delving into the depths of the value drivers, the 8 value drivers. That is, you might say, the levers that are available to business owners that will actually drive and increase the value of their business. Finally, we will have some time at the end for Q&A. So as we go through the webinar today, appreciate it if you just throw your questions or comments into the Q&A box, and we'll get to as many as we can at the end. So without further ado, we might just hop straight in. And so business valuation, why do we need to know what my business is worth? And there could be many reasons for that. We've got a few listed here. So preparation for business sales. So getting your business ready for sale, understanding what it's worth in that connection, restructuring perhaps for tax or investment purposes, succession planning, and intergenerational transfer. So transferring business assets to the next generation or perhaps to key employees, attracting investment, as we said. So an investor coming into your business, do you know what that is worth? Retirement planning, benchmarking growth. So if we're particularly looking for growth, as most SME businesses are, particularly in terms of revenue and profit, well, are we benchmarking the growth in our business value at the same time? Bridging the value gap. So understanding where we are now in terms of business value and where you want that value to be at that point of exit, whatever that exit might look like. And then I guess you could wrap it all up under that final point, which is growing the value of the greatest asset that most of us have, which is our business. So that's just a few reasons on why it's important perhaps to understand what my business is worth, and then flowing out of that, what can I do to impact that value? So we're going to look in a little bit of detail, not a lot, but in a little bit of detail at the basics of business valuations. And I guess we start with the concept of fair market value. And so there's a you might say a technical or a theoretical term there on the screen, which is the generally accepted term of fair market value in relation to businesses. And I won't spend time reading it out. But at the end of the day, your business is worth what a buyer will pay. So it's important for you to understand in the context of your business, what will somebody be prepared to pay for my business? In terms of valuation methods, these are perhaps the 4 most common methods for valuing businesses, in particular private businesses. So discounted cash flow is really a method to calculate the future cash flows from the business and then discount them according to the risk profile of the business. Comparable market transactions references transaction data from the sale of recent comparable businesses in the industry and the market. Net asset backing is just simply assigning values to the individual components of the business, assigning those values separately. So what are the assets worth of fixed assets, what's the working capital value, what's the value of the IP. But the final methodology we've got there is capitalisation of future maintainable earnings, or FME. And whichever way you want to term it, it goes by another couple of terms as well as capitalisation of FME. But this is the most common method for valuing SME businesses on the open market. So probably more than 90% of SME business sales would be valued via this methodology. And so that's what we're going to spend a little bit of time looking at today. So the number one concept to understand, perhaps to get your head around when we're thinking about the valuation of your business, is risk and return. And it's really very simple. That's the two main elements that come into play when we're thinking about business value. So on the return, we're looking at this term called the future maintainable earnings. That is the estimated earnings that will be maintained following the sale of a business. And in real terms, that comes back to EBIT or EBITDA averaged out over the historical earnings. And then we multiply that by the earnings multiple, sometimes known as the capitalisation rate. And the thing that impacts that earnings multiple is that one word we've got on the screen there, and that's risk. So risk versus return. They broadly are the two levers that you have to pull in improving or otherwise the value of your business. So as we said, what does FME look like? It's historical earnings, and typically speaking, that's EBIT, or more commonly EBITDA. That's earnings before interest, tax, depreciation, and amortisation. And the reason EBITDA is commonly used is because it's pretty much a proxy for cash flow. So that's the most common, you might say, element on the return side to be used in a business valuation. So normally speaking, we'd normalise that return for extraordinary income and expenses. So, for instance, recently, a lot of valuations are backing out extraordinary government incentives and so on. We've got various add-backs that are non-operational, such as donations, bad debts, various things like that. And then we get to a weighted average EBITDA, and that really applies a greater weighting to the more recent periods as being more relevant to the maintainable earnings for the future of the business. So future maintainable earnings is a weighted average, a normalised weighted average of the earnings of the business. Then we get to the earnings multiple being the other side of the equation. And without getting too much into the detail, it's directly connected to return on investment. So if you think of a business purchaser of your business as being an investor, the multiple that somebody is prepared to pay is directly connected to the return on their investment that they're looking for. And in simple terms, it reflects a payoff period in number of years. And you can see that in that simple table on the right. So an earnings multiple of 3 reflects a return of 33.33%, going all the way down to a 10 times multiple, essentially being a 10% return. And how risk plays into this earnings multiple really reflects the situation where an investor will be prepared to accept a longer payoff and therefore a higher multiple if the risk is reduced in the business. Therefore, if a purchaser has the understanding that the risk of that future maintainable earnings reducing or otherwise is lower, they will be prepared to pay a higher multiple. And an SME multiple typically ranges somewhere between the 3 and the 8 mark. 3 is very much at the lower end of the scale, obviously, for small and micro businesses, that don't have a great, perhaps, track record or history, and getting up to the 5, 6, 7, 8 for more established, substantial businesses. That said, earnings multiples can be as high as double digits, 12 plus, and particularly in more recent times, we've seen those earnings multiples creeping up a bit, starting to follow perhaps the lead of business valuations in North America. So that's really the two elements. As we said, future maintainable earnings on one side, risk and therefore multiple on the other side. And the simplest way we can put it is this illustration on the screen, that as risk reduces, your business multiple goes up. And it's really as simple as that. And it's a core concept to get into your head when you're thinking about how do I improve the value of my business. So the next section I wanted to cover off on is this these terms here: enterprise value and equity value, and what's the difference between them. And it's a concept that often isn't that well understood. So I just wanted to spend a few minutes going through this. So enterprise value, in real terms, is just a fancy term for business value. And essentially, it's the value of the business sale price. And when we say the value of the business, we're talking about the assets and liabilities that are required for the operation of the business. And so what we do is we exclude any funding, and we exclude anything that's non-operational, so any surplus assets. And then as we can see there, we're excluding debt. So that's short-term and long-term debt get excluded from that value. And so enterprise value in its most simple form is made up of three core elements. And those three elements, firstly, is fixed assets. That is the motor vehicles, the plant and equipment that are required for the operation of the business. And that's the operational fixed assets, as distinct from anything that might be surplus or non-operational. It's working capital, in particular stock, debtors, creditors, and the other minor elements of working capital that are included there. And then finally, we've got intangibles being the third element. And in simple terms, that's the goodwill and the intellectual property of the business. And once we assign an enterprise value to a business, the goodwill is always the balancing number. So we'll have the market value of the fixed assets, we'll have the market value of the working capital, and the difference between the sum of those and the enterprise value is simply made up by those intangible assets. So then we get to equity value. Now, equity value is a little different to enterprise value. It's the value of the company to the shareholders. And so the simplest way to get your head around that is that it includes everything on the balance sheet. So it includes anything that might be surplus assets and liabilities, and it also includes any debt. So where equity value is more relevant than enterprise value is when we're looking at a share sale transaction rather than a goodwill and asset sale or a standard business sale, or also where there might be a partial investment. So an investor might be looking to buy into an existing business, retaining the existing structure, for instance, a trading company. They may be looking to buy in a proportion of those shares. But we're always looking for the equity value. So that's the distinction really between enterprise and equity. And if we want to think about that in simple terms, probably the best analogy that we can come up with is thinking about the situation of a homeowner. Now, a homeowner may have a house that's worth $2.5 million. So that's the enterprise value of that property. Now, he owes the bank $1 million. So that's the debt on that property. So therefore, his equity is $1.5 million. So enterprise value of the home, 2.5, equity value, 1.5. And if we extrapolate that to the business enterprise value, you can see the link between the two. So enterprise value, 25 million. If we've got 10 million of debt, the equity value, therefore, is $15 million. Now, bearing in mind that in some situations, equity value may actually be more than the business enterprise value. And that is because in situations where debt may be limited or non-existent, so therefore the business is equity funded, and it may have surplus assets. So it could be a case where an enterprise value is 25 million, limited debt, and the equity value may actually be 30 million. So just quickly to wrap up, I guess, on this concept about how enterprise value feeds into equity value. You can follow the process here. It's quite simple. The earnings multiplied by that multiple, that earnings multiple, gives you the enterprise or the business value. If we add surplus assets and exclude debt, that gives us our equity value. So quite a simple process once you get your head around it. So that, you might say, is the theoretical side of business valuations, and I've taken that a little bit of a hand gallop and kept to the, you might say, the core principles of business valuations as they relate to SME businesses in particular. We didn't want to get fancy today, and there's you might say exceptions to the rule, and tech businesses may be valued differently, and public companies, we're not going to follow the exact methodology we've set out here today. But when we're talking SME valuations, these simple principles that we've discussed broadly hold true. So if we move away from that, and then we ask this key question, which is, as a business owner, how can I drive the enterprise value of my business in the direction that I want it to go? We come back to these 8 value drivers, and almost irrespective of what your business model is, you should be able to apply these 8 value drivers to your business. And we're going to spend a few minutes on each of these, go through the concepts. Just a quick reminder that if you've got questions as we go along, please throw them in the Q&A, and we will attempt to deal with them at the end. So what is a value driver? If we go back to the concept we spoke about earlier, and that is that as we reduce risk, the multiple goes up. The value driver is something that addresses risk in your business. So therefore, it directly impacts that earnings multiple. Lower risk gives you a higher multiple. And so when we're looking to leverage growth in the enterprise value of your business, what we're looking to do is to impact these value drivers. Number one, and perhaps the most, you might say, obvious of all of them, is financial performance. So, it's not rocket science. Better financial performance is going to impact your business valuation. But it won't only impact you might say, the reward or the return side of that business value equation. It will also impact the risk side, and therefore the multiple. And so the things we're looking at when we're speaking about the value driver of financial performance is we're looking for profitability and margins, obviously good profit, good margins, speaking simply, but also better than industry benchmarks. So if my business is perhaps got okay profits and margins are not too bad, but they're below where the benchmark is for my industry or my type of business, well, it's going to increase the risk for a purchaser. So we're looking not only to make good money and to make good margins, but we're looking to be better than average. Size and scale is very important when it comes to financial performance and how that impacts risk and therefore the multiple. So to demonstrate that point, if we had a business that had a turnover of $10 million and a profit of 10%, and we've got another business that is double that size, so it's $20 million and still a profit of 10%. By definition, the multiple for that $20 million business is going to be higher. And the reason for that is as the business grows in size and scale, it gets more weight and stability, and therefore lowers the risk profile to an investor. So We're not looking to grow our businesses just for the sake of it, but the facts of the matter are that as the business grows in size, the multiple will increase. Stability is important. So what are the trends of the business performance? So a business that is up and down and it's got no, you might say, consistency or stability, that multiple is definitely going to be impacted. Whereas if there's a history of growth and of relatively linear trends, if those things exist, in my business will increase the multiple. And then finally, and you cannot underestimate this point, is the quality and the accuracy of the financial records. So if we think about risk from the perspective of a prospective purchaser, you're trying to give them confidence in that business. And the way to give them confidence and therefore reduce the risk in their eyes is to make sure that you've painted a very accurate and clear picture of the historical business performance and that you're on top of the trends and the margins and everything else that goes along with it. So number two is blue sky. What do we mean by blue sky? Really what we're talking about is growth potential. So if a business is at the start of its life cycle, or you might, or well into the growth part of its life cycle, that is, it's on the incline, it will attract a higher multiple than a business that is nearing the end of its life cycle. So a business on the incline is worth more than one on the decline. Now, room for growth, if you're not sure what the ANSOF matrix is, Google is your friend. Recommend having a look at it. But what we're talking about here are these three elements. We're leaving aside diversification. We're talking about market penetration, market development, and product development. So when a prospective purchaser is looking at your business, they are wanting to understand that not only does it have a good history of profitability and growth, but there's still more room for future growth. So nobody wants to buy a fully squeezed lemon. So market penetration. So is your business penetrated the market that it operates in to such an extent that future growth in that market will be harder and harder to get? So that's the law of the diminishing returns. So a business that might have 40% market share, typically speaking, is going to be worth less than a business that has got a lower market share and more room for growth and less chance of disruption. Market development, once again, is there blue sky in developing markets for the compelling offer that you already have? So the products and services that you already have, is there complementary markets or adjacent markets that have got room to take your business to the next level? Product development on the other side, same thing. Innovation. Is there an innovation cycle in your business that is developing products and services and staying ahead of the curve rather than, you might say, running out of runway for future growth? So that's blue sky. What room is there for growth in your business? Number three is independence. So how reliant is your business, or on the converse, how independent is your business of key players? And when we're talking key players, we're looking at three areas: so customers, suppliers, and employees. And as business owners, perhaps the default is to focus on the front end of the business, that is the customers. So everybody knows that it's a risk if you've got one customer that's, 10% plus of your business turnover. That's relatively straightforward, simple concept. But suppliers, I see not enough business owners understanding the risks in their supply chain, and it's perhaps never been more prevalent or more front of mind than it is now. And business owners are finding themselves caught short. because perhaps they didn't have a plan B for a particular supplier or even a particular region. So are you overly reliant on one key supplier, or do you have a plan B for every supplier in your supply chain? And then finally, employees. So we might think we love indispensable employees, but not when it comes to business value. Indispensable employees are a risk when it comes to business value. So how do you reduce that risk? Upskill and cross-train. And the way to address all of these three areas is to ask proactively ahead of time, what would happen if you lost supplier A or customer B? Or what would happen if a key person in your organisation up and left or was run over by a bus? Are you independent of those players, or is your business heavily reliant on those individuals or on those organisations? Number 4 is revenue assurance. And once again, what we're looking to do here is to reduce the risk that that future return for a purchaser is going to diminish. So what's the risk to the future revenues of your business? Any assurance that we can get around revenue, so any guaranteed income or contracted revenue, helps reduce that risk. And there's different types of revenue in relation to future assured revenue. So we're talking about recurring revenue, and recurring revenue is distinct from reoccurring revenue. So recurring revenue is something where you may have some form of contractual relationship in place. It may be a subscription model. It may be some type of annuity income, but it's revenue that continues to happen essentially without much effort. And reoccurring revenue is essentially repeat business. So we may think we have recurring revenue, but it may actually be reoccurring revenue. Still valuable, but it doesn't give quite as much revenue assurance on that front end. And so if you're in a business where every sale is a new sale, it may be a contracting business, for instance. It may be some form of project business. And you say, well, I don't really have any guaranteed income, don't have any contracted revenue. It's lumpy and I'm reliant on my pipeline. Well, you just need to make sure that your system of generating that revenue is watertight. So you've got a solid system of lead generation, of conversion of those opportunities. And if we've got a history of continually being able to do that, then that is how we address this value driver in those types of businesses. Number 5 is cash generation. And the question that you need to ask yourself is your business a cash cow or is it a black hole? And many of you will no doubt have heard of this phrase where a business may be growing broke. And so the question you have to ask yourself is, does my business actually generate free cash flow? Is it self-funding, even if it's on a substantial growth cycle? Can it fund itself? Or does it require continual input of capital and therefore is not generating that cash return for shareholders? So once again, a demonstration, if a business or a company has a track record of being able to pay dividends systematically to its shareholders, it will attract a higher multiple than a business that does not. So what are the levers within cash generation that you've got to pull? The most critical ones sit under the working capital area. So what is your working capital absorption? And once again, if you don't know what working capital absorption is, I suggest you take a look. Interesting concept. But the simple point is that if your working capital absorption is higher than your gross profit, you won't be able to sustain your own growth or fund your own growth. And so any improvements that you can make in that working capital area, collecting your debtors faster, improving your stock turns, getting better terms out of your suppliers, that will make more efficient working capital and therefore more cash generated or a more cash positive business model. And then efficient use of fixed assets. So the utilisation of those fixed assets, rather than soaking up cash on the balance sheet, are we getting a good utilisation out of what we have invested? So efficient use of capital not only will impact the multiple, but it will also impact the goodwill value, which is what we want. So if you cast your mind back to the concept we discussed earlier, which is goodwill, is the balancing number in your enterprise value. The thing to bear in mind is the less working capital you have tied up in your business, the less fixed assets that you have tied up in your business, the higher the goodwill value. So it's a key concept to get your head around. Number 6, differentiation. So a business that is you might say a Me Too provider or a run-of-the-mill or sits somewhere around the average is not where you want to be. So what are the barriers to entry or the barriers to replication of your business and your business model? Because if your business is differentiated to the extent that it is difficult for competitors to break in on that market, your business will be worth more. So are you a niche or a commodity provider, whether that's products or whether it's services? Once again, a niche business will typically be worth more, not always, but typically. And if you are a provider of commodities, then you want to make sure that you're doing that very, very well. So differentiation leads into sustainable competitive advantage. And if you're going to leverage the value or your enterprise value, you must have a sustainable competitive advantage, and it must genuinely be competitive and an advantage, but it must be sustainable. So you may have a competitive advantage, but it may be about to expire or perhaps lose its edge in the market. So how sustainable and therefore differentiated is your competitive advantage? Then genuine intellectual property is a way to differentiate. So bearing in mind that in most business valuations, the intangible assets are a key element of that business value. What you're trying to do is to give some substance, give some weight to that intangible value. Because a business purchaser is always going to be asking themselves the question, what am I getting for my money? If I'm paying $10 million for your business and $5 million of it is goodwill and IP, what have you got other than hot air to give some substance to that intangible value? So are you building a valuable brand, a valuable, recognisable brand that has got that makes the intangible tangible? So that's differentiation. Number 7 is systemization. So the key concept here is that although every business is operated by people, it must be driven by systems. So if your business is, as we said earlier, if it's reliant on people, and in particular, if it's reliant on head knowledge or business experience to operate effectively, that's dangerous, and it will reduce the multiple and therefore the value. So how can you get your business to a point where it is systems driven, that is systems and process, and people just operate those systems? And when we say we want a system driven business, it's not that people aren't front and center. but it's that you're reducing the risk of that human element. So eliminate, automate, delegate. Key concept when it comes to systemization of your business model, documenting and simplification of processes is critical. And rapid onboarding of people is probably one of the areas that I would say good businesses, valuable businesses, set themselves apart. So it's a key constraint to scaling a business, is the ability to recruit, onboard, train, and get people effective as quickly as possible. Finally, customer satisfaction. So once again, not rocket science. A business with satisfied customers is going to be worth more than a business with unsatisfied customers. Now, we all know that it's 6 times easier to sell something to an existing customer than it is a new one. And so what's your customer churn look like? Do we have a high customer retention, client retention? Now, customer satisfaction, or you might say customer service. I think almost every business owner or every business would love to claim that that is one of the key elements that differentiates themselves from their competition, is we just do a better job. We answer the phone. We're a full service provider. We're a solutions provider. We make our customers happy, etc., etc. Well, is there a system for that? Because you can't claim to put it front of mind and it be a key area of differentiation in your business unless you put a system around it. And so if we're going to put customer satisfaction, as we should, if we're going to put that front of mind, at the front of what we're doing to build value in our business, then you must measure it. Whether that's customer satisfaction score, whether it's net promoter score, or some other system, whether it's a regular survey of your customer base. You must have a system and you must measure it so you can benchmark yourself and also concentrate on improving that. So that's the 8 value drivers. And I want to get to questions quickly. We've got some coming in. But what we've covered off, I guess, just a quick recap, really the key reasons behind why we would value a business and why it's critical to understand our business value. We've looked at the key elements behind how business values are arrived at. Enterprise value versus equity value. We discussed the differentiation in those 2 items. And then we'll spend some time covering off on these 8 value drivers, how you actually make a difference and drive that improvement in the value of your business, not just on the business performance or the profitability, but on reducing risk in your business. So I'm going to wrap it up there and we'll move to Q&A. If you've got any questions, please throw them in the box. We'll try and get to them. Many thanks to everybody that's hung on this far. Trust has been valuable. Please stick around. We will run through these questions now. Before you leave, or once you leave, I would appreciate if you fill out the questionnaire at the end. And in the meantime, we will move to Q&A. So we've got a couple of questions coming here. I'll kick off with one that's a little bit left field, and that is, how are tech companies valued? Specifically referencing Uber and a couple of others. I won't spend too much time on that, other than to say those valuations bear very little relevance to the valuation of small and medium enterprises. So we could spend a few minutes discussing it, but I think we'll just move straight on. Next question is, what does size and scale, or how does size and scale impact your earnings multiple? I think the simplest way to answer that question is really just to think about stability and track record. So a business that has a greater scale, therefore a greater size, has in itself is just a bigger ship, and therefore less prone to various impacts, whether that be market impacts, whether it be competitor impacts, that will have an effect on business value, and that's why the earnings multiple is typically going to grow as the scale of your business grows. So Jerry's asked, are the 8 value drivers in order of priority? The simple answer is no, they're not in order of priority. And how effective each of those value drivers are on an individual business will vary from business to business. So although on this presentation we've got financial performance as number 1, and then we've got blue sky, that may be different from business to business. There's a question on, I should have made this clear earlier on, will the recording be available? Yes, the recording will be available to all that registered. There's a question that's come in regarding the impact of current supply chain challenges on business values. And it's a very interesting question. I'm not quite sure how to answer it other than to say prospective business purchasers at the moment are putting a lot more effort into due diligence in relation to supply chain than ever before. That is, it's always a risk. Supply chain is always a risk, and therefore always an impact on value. But it's never been more of a risk than it is now. So yes, it would be impacting values in some areas. Very much it's impacting due diligence processes. And probably in wrapping that point up, I would say, rather than waiting for somebody to do their due diligence on your business, do it yourself. So spend the time to do the due diligence on your own supply chain. I've got a question here from Michael. How are surplus assets identified? It's a very good question, Michael. And without trying to sound vague, it will vary from business to business, but the core principle is to identify what assets are crucial to business operations and what are not required or don't add value to the ongoing business operation. So, for instance, a company may have, made an investment that doesn't relate to the operating of that business model. That would always be excluded. That's a surplus asset. Cash is a surplus asset, typically. Some would take a contrary view to that, but cash, or at least a great proportion of cash on a balance sheet, is always a surplus asset. But as I said, the core principle is to understand what is required to operate this business. So if I'm going to take this business out of the current structure that it's in, take it away, put it in my own structure and operate it, what assets will I require to purchase from you to keep that business going? Paul says, how's the best way for risk drivers to be benchmarked in a particular industry? So it's a good question, Paul. I don't think you can benchmark everything. However, there are a couple of key areas that you can benchmark. Financial performance is obviously one of them. You know, and there's publicly available data, and there's also data that you will get, you might say, from your own market intelligence. So understanding the industry that you operate in, and taking the time to do your own benchmarking or your own comparatives, not only on financial performance, but on some of those other elements. And probably finally, wrapping that up, I'd say, you know, get a good grasp on your industry. So not just on your, you might say, your direct competitors, but those that might be on the fringes. Get a good understanding of the whole of your industry and benchmark yourself. That is, weigh up these value drivers and how your business performs, perhaps versus your take on those others in the industry or on the industry average. Brandon's got a question here. Could you comment on the relationship between an investment which improves profit, such as a new forklift, and how that ties in with reduced goodwill? This needs to be looked at to ensure that increased earnings and multiple will outweigh the increase in fixed assets. Yeah, good question, Brandon. So I guess what you're referring to is the fact that as your fixed assets increase, your goodwill also increases. So the first point, I guess, to bear in mind is that most businesses, as I said, are valued on EBITDA. So the depreciation costs are therefore broadly going to be excluded on the profitability side of the equation. When it comes back to the enterprise value, you really just challenge each asset in isolation, and you say, is that 30,000 or 100,000 or $500,000 that I've got in increased fixed assets, is it adding additional value to my business? So is it actually improving the performance or the efficiency of that business and of that business model? I trust that helps. Tim's asked about an outline on IP value and how much it affects overall value. So I think the key concept, Tim, is to understand that IP, for the most part, gets lumped in with goodwill and is an intangible asset. However, intellectual property is generally what can be identified, and goodwill is perhaps the things that can't be specifically identified. So the more you can shore up that intangible value in your business by, you might say, identifying it, registering it, protecting it, and building on that value, the more it gives substance to that intangible portion of your enterprise value, and therefore the less risk it will put on that for that future purchaser. Jeff has asked, what is the benchmark for working capital efficiency? Once again, Jeff, it will very much vary from industry to industry and business model to business model. I think there's probably two things that I would say. The first is to understand the relationship between working capital absorption or efficiency and your gross profit, because that will give an indicator on your ability to fund future growth. And the second relates probably back to Paul's question earlier, which is understanding benchmarks on various drivers. So understanding where your industry sits, typically in relation to that working capital efficiency. The final element that I would probably just add in is working capital efficiency at the current time is taking a bit of a hit and justifiably so, because of the impact on supply chains. And so you might say some of the ordinary areas of focus on improving stock efficiency and so on has somewhat gone out the window. And the strategic decisions being made in relation to investing in stock and what's required just to make sure that the business is sustainable into the future. So that's just a point to bear in mind, is that particularly at the current time, perhaps wouldn't be putting quite as much focus on that inventory efficiency as one normally would. There's a few more questions here, but we are going to have to wrap it up very shortly. I'll just finish off with this one here from Mike, which is, how can I find out the benchmarks in my industry for GP, NP, etc. Once again, Mike, there's publicly available information. So there's industry reports that you can get from providers such as Ibis World and comparable providers. But there's also work that you can do yourself, just in, you might say, the ordinary process of gaining market intelligence. And so it's not necessarily about, getting down to the last bit of data and information, but taking the time to understand your industry and where you fit in it. So are you above average or below average? It's a key concept to get hold of, and will help, you might say, focus on the areas that need the most improvement within your business. We're going to wrap it up there. Really appreciate everybody coming on today. As I said, if we can just take a couple of minutes just to answer the questionnaire on the way out. Appreciate everybody taking some time out of their busy schedules to attend today's session, and hope you can join us all again next month.